Good afternoon, everyone. This is Managing Partner Dan Girard of G9 Financial. I am here with one of our guest speakers, Jason Dahm. Jason is with Tag Invest, a key partner of G9 Financial when it comes to management of customized investment portfolios and tax strategies. And Jason provides a lot of insight for us around those two, amongst primarily those two, but amongst other uh, ideas for investment planning. Jason, how are we doing? And welcome to 2026.
We're doing well. Thanks for having me, Dan.
Good. So, Jason, just a kind of quick overview, bringing you on today. We're just trying to get a sense of what you feel, how 2025 ended up, based on the things that you're seeing on your side of the table, and where you might think things are going for 2026. So let's start with 2025 first and give a little recap.
Sure. Yeah, we'll look backwards in order to look forwards. For a lot of things, I think for both equities and fixed income, from the typical view is you start with equities and you work your way down. I
Mhm.
kind of prefer to start with the fixed income side because ultimately 2025 was a great year for the fixed income space. We saw a lot of outperformance. We saw the Fed cut rates a couple of times, and ultimately credit spreads stayed about where they were and actually tightened a little bit. And so
Mhm.
as a result, the Barclays Ag actually ended up in a plus or more than 7% positive territory, which is higher than what its coupon return would be. You look at that from a kind of an expectation setting standpoint for looking forward. The fixed income space really is fairly range bound in that it can't exceed its coupon forever. So when it goes above like that, and we have a year, it kind of resets expectations for what you should expect to get from bonds and from rates on a go forward basis. Now we're looking at probably coupon yields in the 4.5 to maybe 5% range if we're stretching into credit spreads. So expected return lower. What that means for equities then from a just comparable, risk plus type of scenario, it leads us to then say, all right, now our floor for what we expect to get from equities would also be lower as well, kind of from a build-up method. And that's pretty reflective too as to where things have gone and where we have been in the equity markets. Obviously, last year was another double-digit year for the S&P,
Mhm.
up around 15%, 16% again. International equities did even better than that. Had a bang up year. Finally had some
Yeah.
what we've been calling for a while. I guess you call for it long enough, it'll actually get there. Then the internationals caught up. Still think that there's some room to run there, but you look at it on a backwards looking basis. 3 straight years in double digits. Again, that's something that's difficult to repeat. In the axiom of sports, it's really hard to go back to back to back. We were
It
just
is.
talking before off camera about the run the Patriots had. That's pretty rare. And even the greatest Tom Brady teams didn't win 3 straight. And to do 4 straight is almost unheard of. And so to do that within the equity markets, I think we could still see positives, and we could get into the earnings expectations if sort of the growth estimates hold and we don't see any type of multiple contraction, that we could probably see mid to high single digit type of returns in equities, sort of a return to normal. But that's kind of, I wouldn't necessarily say best case scenario, but it would require a pretty significant amount of expansion and further multiple expansion in order to get into that kind of fourth straight year of double digit returns. So in other words,
Sure.
I would say for your clients, mute the expectations a little bit. I think that you could still look at things as being positive and have a good degree of, a positive outlook for both equities and fixed income, but just recognize that, repeating the recent past probably isn't going to be quite as maybe as reasonable from a go forward perspective. Earlier part of 2025, a lot of the analysts were calling for sort of a return to a 10-year normal and looking at low single digits. Well, that sort of ended up turning on its head midway through the year. We had a pullback, if we recall. It seemed like a long time ago, but with the tariff and ultimately Liberation Day announcements, part of April we were down in not just correction territory, but almost bear market territory, and
Yeah.
we were able to recover back to these positive returns. I'm not saying we could get back to that level again, but it doesn't take a lot of catalyst for us to return to that level at these valuation levels. We're really keen on pointing out that there's a CAPE ratio. It's a modified price to earnings ratio on a longer term inflation adjusted basis. And where that ratio is right now, it's about levels where we saw it in late 99, early 2000, right before the dot-com crash. Again, not calling for crashes, just saying that valuations are pretty rich on a historical level. So that means that when the rubber band stretches, it can go back fast too.
Mhm.
We don't know when that catalyst is going to occur. So we could see positive, but there's also some, maybe some muted and, measured expectations to be managing risk along the way.
Yeah, and I agree with that. I go back to April and ourselves as we kind of look at back and recap. We had a lot of panicked phone calls coming in, right? And I know for us, and I know you preach this also, we kind of build a strategy plan of money now, soon, later for our retirees. That now bucket is their distribution dollars, and ideally to kind of stick to the plan. So when it does snap back, because when things are down, I know how we look at it is that's an opportunity, and I'm sure you do too. When things are down, that's an opportunity for where the money is made, right? So you're buying low, kind of resetting the allocations, so on and so forth, so you can bounce back when that opportunity presents itself, and then stick to the plan, and ideally you're able to participate. And as I joke with a lot of our clients, is no one's really calling me when things are good, and that's fine.
True.
That's what I signed
Yeah.
up for. We also signed up for when things are going awry and you're not sure where to go. We're here to walk you back off the ledge. So,
Well,
which
and
is
and
good.
certainly, I think that I would so totally agree with that sentiment. And the putting yourself in the shoes of your clients is that when the markets do get a little choppy, staying the course is always easier said than done. And
Oh
one
yeah.
of the ways that we've tried to work around that, not just being opportunistic with rebalancing into some of that weakness, the buy low, sell high mentality, but also is using our internally designed products that we've built that have that lever to them to the downside, effectively giving us a little bit more of a cushion to work with on the timing, so that
Sure.
if the markets do pull back, we're receiving something that I like to say the zig when the zag. If the
Yep.
market's pulling back, we're going the opposite direction on a pretty good chunk of our money. And especially given the fact that I mentioned expectations for fixed income are now at an even lower level, we'll use a fixed income bond replacement or use these products, these dual directional structured notes, in lieu of those bonds,
Hmm.
so that ultimately we're still clipping a positive carry like we would with a traditional bond, and actually getting a little better yield. But then if the market pulls against us, and when that unknown catalyst occurs, we're going to have something that's going to not only outperform, but actually outperform to a degree of leverage that's going to offset quite a bit of the choppiness in the equities. So being prepared for that and having that in place ahead of time allows us to then have those psychological conversations with the clients around, hey,
Absolutely.
stay the course. We can point to something very specifically in their portfolios to say, look, this is something that you can recognize and anchor to when the things get a little choppy.
Yeah. Right, which is great. And so, Jason, as we kind of look at 2026, you kind of, hey, going 4 for 4 in a baseball game is hard. Yeah, to go 4 for 4 with 4 home runs is really hard. What do you think for 2026? Just
I
can we be
mean,
positive? Can we? Now I know I always say this also. We can't control what's going on outside those windows right there. I go back to I remember in 2001, we're kind of already on a downslide. We had a kind of not a very major event in New York City that sent us into disarray for a number of years. And now that I'm not saying that was the only catalyst, but that was a catalyst. Um, Taking that all aside, if things stay kind of on the same path, can we be positive, or are we
I
due
think
for a
I think
reset?
so. I mean, again, it's just a matter of how long can the good times roll. When you look at other than just the disruptions from COVID was definitely an anomaly
Mhm.
for purposes of the economy. 2022 and the sort of the disruption that we had from interest rates and the impacts of inflation, also kind of an anomaly. You take those pieces out, and we're looking at really 7 straight years
Yeah,
of positive, 8 really, in terms of really positive momentum. That's really tough to maintain on a longer term basis, particularly since it's been in double digits. All that being said, I would still say expect to receive and have some level of positives, because ultimately the corporate side is what's going to drive all this in
sure.
terms of the true valuations in the marketplace. They're supported with earnings, and the earnings should expect to be positive. Interest rates are expected to stay at or remain lower, so that's going to put less pressure on corporate balance sheets. And as long as consumer sentiment and people keep spending, things should maintain. It's just a matter of expecting the unexpected of when it could pull back. Not saying it's going to, just being prepared for it to do so. So be cognizant and cautious while being optimistic. And that's the way I would call myself, cautiously optimistic for 2026.
Yeah.
So I would say, if you want a number, somewhere between.
I won't hold you to a number. No, I never hold anyone to a number.
Good, good. I appreciate that.
Yeah, but the point is, be optimistic, and it's not about avoiding it to a degree. It's about being prepared to get through it, right? So, and you can't be prepared to get through it when you're in it. You got to do it beforehand. So it's a good point.
Be prepared, but then just stay the course too. The other side of it is don't panic sell thinking that things are so expensive that we have to get out. Because if you would have listened to the experts, myself included, at the beginning of last year, I'd have said, well, about the same thing. And the markets were double digits. So from that perspective, stay the course, stay invested, stay long, just be doing so with the measured individual expectation for yourself, for your own circumstances, and making sure you've got those hedging instruments in place to protect and bucket what you do to make sure that your money now is protected, that's safe, and that your longer term money stays longer term money.
Yep, and it's not about timing the market; it's about time in, right?
Absolutely.
As boring and as silly as that sounds, it is so true. Well, good. Well, Jason, is there any last comments you want to add, or last final thoughts?
No, I think stay the course there. I talked a little bit about international too. I see that we've had a lot of momentum currently in the large cap domestic space. A lot of drivers from the AI story in particular.
Sure.
Your international names are not going to be as participating in that. So a way of diversifying yourself and getting more broadening and more participation in the broader market is to also look at not only other industries that have maybe been passed by recently in this recent bull run, your more value oriented companies, your energies, your financials, your industrial sectors have really have underperformed and maybe have some room to run.
Sure.
Companies internationally tend to be more filtered or more driven towards that because, Europe doesn't have a Silicon Valley, right? So that also allows for further diversification into those spaces. So I would say look internationally, tailwind currency wise also look good. Keep stay the course with that as well. And let mean reversion take its course.
Perfect. Well, Jason, thanks for the thoughts. We really appreciate it. And I'm sure we'll do this again at some point throughout this year. And really appreciate you spending some time with us today. Thank you so much. And for those who have questions or concerns about their current investment plans, financial plan, or whether you're with us or not, feel free to reach out to us at g9financial.com. Again, this is Dan Girard, managing partner. And thank you for your time.
Absolutely. Thanks for having me, Dan.
Thank you.